All right. New York, REIA, New Jersey, REIA, and Philadelphia, REIA. We are excited to have you guys here with us for today's topic. We have some amazing guests. We are going to give people a few minutes to come and join us. So just hang tight for a few minutes with us, and we're going to get this show started here shortly. Also waiting on one of our final speakers, which will be joining us here in a moment. Actually, let me text John. So let me ask you guys while we're live for a second, how the adjustments been with the webinars, the Zoom calls. Do you guys like them better than doing all the in-person stuff? What's your guys' perspective on that?
I don't know. I personally like to have the in-person. Been doing that for over 20 years. I kind of like it. I know a lot of the younger generation, they're into the webinars and the Zooms, which is kind of cool too. But I just feel there's nothing better than, hi, how you doing? And eye-to-eye contact. But
I think it is a good alternative, though. At least people still have the ability to come out and get educated or network. So it isn't a total downer, but I think we would prefer, hosting something.
Yeah, like the in-person stuff. So you gentlemen sound like gentlemen who like the emotion and the empathy of the event. Yeah.
Absolutely.
And then there's me.
How about you? For you, Eric?
So I mean, I've been helping clients nationwide for 11 years. So I've been used to the screen shares and the phone conversations even before I was, in video with them. So it's nice now that the rest of the country, is now up to par on what I've been doing for 10, 11 years. It's now it's the norm. Now there is no, hey, can I come to the office? I'm going to save you a half-hour trip into the office. I'm going to save you time in your car, and now we can be more efficient. So I love it. I love the interacting through Zoom. Yes, I miss the networking perspective, but the client interactions and meetings through Zoom has been a big plus, and it's just more commonplace now, which is nice.
Yeah, and I mean, not only is it 30 minutes just to your shop to meet you, but then it's also 30 minutes back, and that's a whole hour in a day. You only got 24 of those precious babies, so there's a lot you can do with an hour for sure. So that's definitely a good point. I like it. Hey, listen, for you guys who are joining, we got a lot of people joining in with us right now. If you guys are excited for today's event, go ahead and hit the like and share button for us, okay? Really important that we get this message out to a lot of people. I promise you today's event is going to be an event that we have not done before. We're going to be discussing topics, what's going on in the current market. We're going to have a lot of fun today. So please make sure you guys hit the like and share button. Let's get more people here. Let's get more people involved with us. And in addition to that, today's topic is about money, guys. If you don't let your friends know what kind of investment opportunities you're doing, what you're learning, you're leaving a huge opportunity out on the table to run across potential money partners. So make sure you hit the share button. This way, all your friends know how you're educating yourself in these current economical conditions, because it's us that educate ourselves during these downtimes that we start thriving as soon as, things get rolling. So make sure you hit the like and share button. We're going to get started here in 1 second. We're waiting on John to join us. Let me see. And by the way, for those of you guys who are just now logging on here with us, let's go ahead and get this comment section engaged. Okay, I want to know what you guys are all about. So do me a favor, put it in the comment section, drop it down below right now, and let me know where you're tuning in from. We got New York, New Jersey, and Philadelphia on this call with us tonight. So we're going to have literally hundreds of people on this call. We're already climbing up in the numbers now. So let me know where you guys are tuning in from. You guys coming from Philly? You guys coming from West Philly, Brooklyn, Bronx? Just let me know. Let's start pinning some of these up so we can see what you guys are up to. You guys can't see the comments, right? No, you guys can't. I don't think you can. No. But I can, so we're good. I'll pull them up. Let's go. Put them in the comment section. Drop them down below. Here we go. All right, we got Anita joining us from New Jersey. Where you at in Jersey, Anita? You know New Jersey's big, and there's a big debate. Is there North Jersey or South Jersey? And if there is a Central Jersey, that's the debate, okay? Let us know where you're tuning in from. We got Terry coming from Westchester County. Shout out Westchester. Pleasure. Glenn, Paul, do you guys want to let us know where you guys are tuning in from?
We are from Teaneck, New Jersey, in Bergen County, just over the George Washington Bridge.
Love it. And Eric, where you joining us from?
Down in Sewell, New Jersey, down in Washington Township, down south. Not one of the Washington Townships up north.
I love that, man. We're excited to have you guys. All right, we got Bob. Bob's coming from Brooklyn. What's up, Bob? We got Mario from Bergen County. Shout out Bergen County. It's right next to Teaneck. Yes. Anita's from North Jersey. Carlos is from Queens. Shout out Queens. Robert, Raritan River. All right, we got John Palumbo joining us. Mr. John.
Oh, sorry. Technical problems. How you guys doing?
Oh, you're good, brother. Take your time.
Right.
All right, we got Greg from Long Island. So real quick, John, you ready? You good?
Yeah, I'm good. I'm all ready.
How you feeling today? Everyone's feeling well?
Feeling well.
You guys fired up, ready for this event?
Absolutely.
Hello, John.
What's up, John? How are you?
How you guys doing? Good to see you.
Yes, John.
All right, so hey, listen, real quick, guys. Kate, today's topic, we're going to go ahead and get started, all right? Today's topic is all about money. Now, this topic is so important whether you're brand new, just getting started, or whether you're super experienced, okay? More specifically, today's topic is other people's money. I remember I was reading one of Robert Kiyosaki's books, and one of the things that he was sharing was that, yes, you're able to get some great investments if you're using your own capital. You can expect some pretty, good returns and stuff. But if you're really wanting to scale, if you're really wanting to, know what it takes to have a team in place and really take things to the next level, he's preached that you really have to understand how to use other people's money. Because whether you have $100,000 or $500,000 or whatever, there's so much more money that's out there. And these three guys that are on here with me this afternoon that are with us, we are going to get to dive in with them and understand what they know about money, what's the best ways to work with them, what services do they provide. And I promise you, if you can figure out how to, create relationships with these guys, your business is going to exponentially grow. Whether you're just getting started and you're trying to get your first deal, or maybe you're super experienced and you have a constant deal flow going every month, every few months. These are the guys to plug in with because they can help you take your business from wherever you're at and really help you take it to the next level. And in order to get to that, though, there's one thing that we all have to have, and that's financial intelligence. Really understanding risk, really understanding the opportunity, really understanding what's it going to take to fulfill this opportunity. And with these three gentlemen today, we're going to get to dive into all that. We're going to get to understand how they analyze, how they look at deals. What are the things that they look for? Because these are the guys that are out there in the field daily analyzing deals. They're lending the money, right? They're offering it to investors such as myself and as well as you guys. So we're super excited. Today's topic is one of my favorite because it's all about the money, all right? And I'm super stoked to jump in, all right? So for those of you guys who are joining in, please make sure you hit that like and share button. If you haven't already commented in the comment section to let me know where you're watching from, do that now. And last but not least, if you're excited, if you're fired up, if you're sitting on your couch and your grandma's in the kitchen cooking fried corned beans and cooked potatoes and all that, you better let her know you pumped up for today's event. All right. I'm ready to learn. I got my notes. I got my paper. There's literally nothing on here. Okay. I don't have pre-written questions. This is authentic. This is live. This is raw. We're going to dive in and we're going to have some fun today. So with that being said, okay, for you viewers who are watching, some of you guys are catching the recording. If you guys have any questions at all, put them in the comment section. We will be getting all your questions answered throughout this event. Okay, at the very end, we're going to open up for a big Q&A. It is now 7:10. We will have this event over by around 8 o'clock, 8:10 at the latest. And then at the end, we'll open up for questions. So we'll be able to get everything answered from you guys. So with that being said, I want to take a minute and just kind of get into quick little introductions from all of our speakers here today. Very important that you guys take notes on literally everything that they say because they're going to be dropping bombs throughout this whole webinar, and I'm super pumped up. So my name's Elijah. I'm one of the hosts of the New York Real Estate Investor Association, New Jersey Real Estate Investor Association, and the Philly REIA, and we're super excited to have you guys here with us. Do want to let you guys know, quick little sponsor thing, okay? Today's event is free. If you got access to it, you got it for free. This is going to be one of our last events that we do for free. We've really got to understand the online community, the webinars and stuff, and we record all these events, and they typically go advertised out for free so you can watch them for free. But in order to get access to all of our events now, we are putting them onto our website, which is superiorinvestors.com. And in order to get access to that website, you do have to join our membership. if you have any questions or you want to know more about the membership or you're just interested in all, just go to superinvestors.com and you'll get to know all the details. So with that being said, let's start off with Eric from the MB Capital Solutions. Eric, please give our audience just a quick, introduction. Let us know kind of what your company is and what you guys are all about.
All right. So thanks a lot, Elijah, for having me on here, and hopefully I can keep the crowd moving. So my name's Eric Moz, owner of MB Capital Solutions. I'm also a funding strategist on the team, and what we do is we help small business owners and primarily real estate investors to position themselves to take advantage of opportunity. Our niche is the unsecured lending space, and showing people how to obtain unsecured lines of credit that they can use for every aspect of their business, whether it's working capital, down payment money, gap funding. You see the sign behind me. All of those different ways that you can use the line come into play.
We appreciate that, Eric. I know a lot of people are very uneducated over the credit space. Even myself, I'm no expert at it. So Eric, we're excited to have you on here with us to hear your experience and to dive in with you. So thank you, Eric. Up next, let's go to John Palumbo from Freedom Mortgage. Shout out Freedom Mortgage. John, what's up, man?
What's going on, guys? Good to be here. Thanks for the intro, Elijah. Thanks for having us, of course. So just a little background on myself. I'm a mortgage banker. I'm also a real estate investor. I started investing when I first got into the business, so almost 19 years ago now. And so I'm very familiar with the investor language. And although we're a traditional lender, Freedom, myself, we're really, really investor savvy and investor friendly, which a lot of mortgage companies aren't. And you're going to get a lot of really good information here. And a lot of times people tend to automatically go to the hard money, the private money aspect, but there's a whole nother world in the traditional lending that a lot of people just don't know about. And that's part of the reason why we do these podcasts, is to educate you guys, because it might be the best option to go with a traditional loan. It could save you a ton of money. We also, one of the specialties that I deal a lot with is renovation lending. I've been doing the renovation loans since I started. That's a niche. You have to know how to do them. They can be difficult loans to get through, but Freedom is known for their renovation loans. We have departments that just handle them and probably have the cheapest rates in the market, cheapest cost in the market. So definitely a good avenue to consider the traditional lending. Also, I work a lot hand in hand with these guys to get you out of the hard money, the private money. When you need an exit strategy, you work with these guys, you come to me after, and I get you out into a more traditional permanent type of loan. So a lot of good stuff that we can help you guys with. I'm excited to be here.
John, thank you so much. I've done a lot of business with John. Definitely a great guy to work with. So we're excited to have you as well, John.
Thank you.
All right. And to finish off with our intros, we got the one, the only from Peak Private Lending. Listen, you guys, there's a lot of investors that are talking about you guys right now just from all the work that you guys are doing, especially during COVID. You guys stuck through it. You guys are literally offering killer programs right now. So Glenn and Paul, welcome. So grateful to have you. Say what's up to our audience.
Hello, everyone.
Hello. Thanks for having us, Elijah and Nick. Always a good time at your events.
Yeah, absolutely. Okay, you want Senior to start, I guess?
Absolutely.
We'll start. And then Paul has some really exciting things to talk about when we get into the hard money private lending. My name is Glenn Gallucci. This is Paul Gallucci. We own Peak Properties and Peak Private Lending. Peak Properties is our company that we actually buy properties, renovate, and sell them. I've been doing that for well over 30 years. Paul's been doing it, but probably close to 20 now. He's getting up there. And from there, I noticed, we used our own funds, and then we started to use some friends' funds, because in this business, when you're buying and flipping houses at $200,000 and $300,000 and $400,000 a piece, you can go through $1 million very quickly. So what I noticed way back in probably the late 90s was a lot of investors, especially beginning investors, didn't qualify to go to banks or go to traditional hard money lenders, and they didn't know how to get a private money lender. So tonight, which we're gonna tell you the pros and cons. They're all good methods of obtaining funds, and we can give you a really good insight on maybe when you should use the hard money, when you should get private, how to get private money as well. So we helped a lot of investors get started. Especially, like I said, the beginning investors. The seasoned investors really like us because we're fast. They're in-house funds. We don't need any approvals from anyone. Right here is the final approval that we give. and we could do it quickly. So the speed and the flexibility really brought in a lot of seasoned, experienced investors. We all know the value of cash flow and everything, and so, again, we offer tremendous different programs for that, for both beginners and seasoned.
And I think just an important thing on a macro level, the thing to take away with it, and I think Elijah, you touched on it, and John, is we encourage everybody to build relationships with multiple sources of capital. You never know, which avenue may suit you best in a particular situation. I think we've all learned a lot, since COVID in March. Things change, programs change, environments change. So I think, if we can't stress anything enough to the investors out there is, vet your capital providers, build relationships with as many of them as you can, and use them. Just think about each one in your tool belt of things that you can, use and deploy. And I think, John kind of said too, people may not know the type of programs that John offers. So to build a relationship with a guy like that, or to speak to Eric about some of his programs, I think it's a thing that everybody, and we encourage them to do.
Man, that is great. Glenn, Paul, thank you guys so much. I'm so excited. It's an honor for me to be on here with you guys. So definitely appreciate you guys so much. So with that being said, guys, let's kind of go ahead and dive in. One important note that I need to share with everyone, okay? Everyone thinks that, hard money is hard money, or private money is private money, or conventional loans are conventional loans, and credit is this or that. That is the conventional way of thinking about things. And with the way that we are in today's economy, it is forever changing, and it's changing so fast on a daily basis now. And I think it's so important to really understand what are the specific programs, what makes, this lender different from that lender, and when is the correct time to use this lender. Because if you're trying to go into every deal with hard money, it may not always make sense, because you might leave some opportunities on the table, when instead you can roll into a conventional loan with John and really just, kill it with the loan programs that he offers, and vice versa. If it's a huge rehab and you need to get in and out, right? There's times to use private money, there's times to use the credit, and there's times to use the conventional loans. And so with that being said, I kind of want to start off with John Palumbo, right? Talk to me a little bit kind of how you got started in the lending space. And if you could share with us a few examples or, case studies, or just give us a brief overview of how investors are working with you today.
Yeah. So, things have, with the COVID, things have really tightened up, but fortunately, Freedom still has a lot of all the same programs, more reserves required. Things have changed a little bit. But just to kind of go back, when I started back, I was just out of college. My family's in real estate. My mom's a realtor. So I started doing the real estate. She's like, why don't you go into mortgages? That's what I started to do. But I really, from the very beginning, I was financing deals for these investors. And I was like, wow, these guys are making a ton of money just by buying, flipping, whether it was they're wholesaling deals, or they're renovating and selling, or just holding on to properties and renting them out. And I was just amazed. I was like, if I can do this, if these guys can do it, I'm financing these deals for these guys, why can't I do this? So that's what really intrigued me to really understand the world of investing. It's really the best thing I ever did. Now, in terms of how financing is going these days, the credit requirements are pretty much the same. Some banks have pulled some of these programs. Some banks have maybe increase their credit requirements. Fortunately with us, we did that initially, and now you're seeing all the programs start to come back. Okay, so minimum 620 credit scores on the conventional lending world. Okay, generally you're looking at a 75 to 80% loan to value type transaction. These are full documentation loans. Rates are as low as down to the threes right now. They're super low, the lowest that they've ever been. We'll see what happens when the election time comes. But, it's really good. Cash outs are restricted a little bit right now with investors. There's some banks pulling away from doing cash outs. It's those riskier type of transactions, multi-unit cash outs that, some lenders are trying to stay away from. But we're still doing them. We're doing them every day. And, it's always a good option to have on the table. A conventional lender like us, I'm taking a lot of deals from other lenders that just can't do them. So there's been a lot of changes. So we kind of have to go with the punches right now, but you're starting to see a lot of that come back, which is good. Which is good. So that's where we are at this moment.
Yeah, no, I love that. So John, just real quick, right? for anyone who's out there, and let's say, you know, they may know of a conventional rep or, you know, conventional loan rep or whatever, what do you think it is that makes kind of your guys' company, like, you know, a little bit different, and a little bit about your operations? What makes you guys a little bit different than all the other lenders that are out, conventional lenders that are out there at the moment?
Yeah. So what I've always liked about us is that we're traditional, but we think outside the box, and we're very, very aggressive. We take a lot of risk. You know, needs to make sense. A lot of lenders have kind of a set in stone rules and regulations. We really do try to think outside the box. And if there's a product out there that we don't have, we look to get it on board. We look to see what's the next best thing that's out there. How do we make these borrowers qualify? What can we do differently? So that's, I think, what really sets us apart.
Yeah, no, that's great. Because you guys are definitely nitty gritty. You know, you're on the phones, you're trying to figure it out, all that stuff.
Yeah.
So
yeah, I mean, for your primary home buyers, I mean, we're going down to 500 credit scores, you know, as low as you can possibly get. You know, lenders don't touch those kinds of things. So Freedom is a very aggressive lender. We really, if it makes sense, we're going to do the deal.
I love it. So let's say I'm an investor. Let's say I'm a new investor. You know, can you kind of talk to me about like a deal? Like, let's say it needed a little bit of work. Maybe I wanted to do the 203K loan option route. Can you kind of talk about like what that program's about, and, you know, who do I need to be to qualify for something like that?
So for the investors that are out there, you have the 203Ks, which is for your primary home buyers, which is a very popular program for a renovation loan. But for your investors, we also offer a Fannie Mae home style loan, which most people don't really know about. I do a lot of trainings on this product. It's just like a 203K, but for you investors that are out there. So how great would it be to get the bank to finance the money to buy a property, renovate that property with as little as 15% down payment, and get a rate probably in the threes, okay? Closing costs are minimal compared to what's out there. Okay, these programs take a little longer. They're going to take you 45 to 60 days to close. So just as like we're saying, this may not be the best product for you. You know, you may want to go to a hard money guy to get, you know, a closing done in 10 days or a week. I'm going to take 45 days at a minimum. But the benefit of what we do is that you're going to save a ton of money, and it's a fixed 30-year mortgage. You don't have to refi out of it. So it's a great buy and hold product. It's good if you want to flip flip the house. There's no seasoning requirements. A lot of lenders impose seasoning. We do not. Okay, so you could buy it today, flip it in a month if you wanted to. So a lot of benefits. But the renovation loan, the home style, is geared for you investors that are out there. And again, it's something that a lot of people just don't know about. So, you know, look it up. It's a Fannie Mae home style loan, and we do a ton of them.
Yeah. So just to make sure I'm hearing that correctly, right? Ideally, it's going to be something that's going to take a little bit longer to originate. So if we can structure the deal in a way where we have a little bit more time, right? Where time isn't necessarily like where we need to hustle for the time.
Yes.
We're looking anywhere from 45 to 60 days. And you guys are requiring anywhere from 15% down. Is that just single family? You guys do that for multi as well?
So the renovation loan is for investors. It's for single family only. If you're going to live in the home, you could do a 1 to 4 family. So investment single family only. Eventually, hopefully they'll change that, but right now it's strictly limited to single families. Yeah.
Okay, not a problem. And you said that rates right now can be as low as 3% for this loan?
Yeah, 3.25. Yep, they're very low. Yeah, it is. It really is. Yeah, I mean, it's, you know, the banks right now are so inundated because everyone in America is refinancing. So everything is moving a little slower because the rates are just so low. So we refinance a lot of these clients too, even into renovation loans. If you own a property and you want to renovate it, we're going to use an after improved value. People think that they're stuck in a house, there's no equity there. That's not the case. They can jump in and refinance that property and add another $100,000 to $200,000 of value, which the bank will take into account based on the repairs. So they can stay in their home, renovate it, and add an addition and have enough equity with the after improved value. So it's also for refinances as well. Yeah, it's a really great program. Absolutely.
Yeah, no, that's great. And so for any investors who are out there, you know, they can structure the deals where there is a little bit more time. Like if you can get a loan right now around 3%, like it's gonna be killer because it's such a cheap source of capital.
Yeah.
Yes, it takes longer, but I mean, if you could structure that, you know, that's more money for you.
Yeah, you have to have the time to do it. That's all. And if these are full doc loans, we're going to qualify you based on your credit, based on your income. We're going to look at, you know, W-2 income or self-employment income. We're going to ask you for your taxes. So there's a little bit more involved than, you know, the hard money process would be. But again, it may not be the best thing for you, but it may. So it's good to know that it's there.
Yeah, so that's very important because everyone, like, you know, they have jobs. Like I've been asked so many times at our live events and even like through Messenger now today. It's like, you know, should I quit my job? I want to get into this real estate stuff first time. maybe they just completed a deal and made 50, 60,000 on it. I'm like, I wouldn't quit my job yet. Like you get better benefits than what I get, with the W-2, with the loans that you guys offer. Like I would never qualify for any of the loans that you offer, but thankfully, if you structure partnerships with people who have W-2s, we could send you business for that and do business that way. So
and also, to make yourself bankable too. When you're self-employed, it's important. I have a lot of conversations with my self-employed borrowers. Sometimes they just tend to write everything off, and sometimes you have to say, look, I'm willing to report a little bit more in income or take some expenses out, but I'm making myself bankable where I can get a loan. And think about how much money they're saving by doing that. Yeah, they may have to pay the IRS some more money if they're taking less expenses, but nonetheless, they can now qualify for a mortgage. Now they can get a loan, at very favorable terms. So I usually have I have a lot of conversations with these guys about that. And I think they're starting to realize, hey, this does make sense.
So whenever you say the word bankable, can you kind of walk me through like what that means?
Yeah, meaning that they can actually qualify for any kind of financing that's out there. They're going to be choosing the financing. Someone that doesn't report income or has issues with credit, they're forced to go a certain direction. They're not going to get financing. They can only go here to get financing. When you have decent credit, you're showing income, you have some money in the bank, now you have a whole world of things open to you. Now you can decide what's best for you. So if you can take that income part of it and, not wash out your whole tax return, it's going to make you a much more, you're going to have banks that are going to give you a loan, no problem. And that's the whole point. It's going to save you money and it's going to give you a lot of different options. So that's what makes you bankable. Yeah.
I think that's such a important concept. And for anyone who's out there listening right now, like it's so important to understand like how you need to look so banks love you. Because if you can look the part, and I don't just mean like look hypothetically, I mean like actually have all the, the documents, the partnerships, everything in place, like the money's out there. You have access to it. And John just told you exactly how you can get it from him and how you guys need to look. So that's definitely a good point there. Yep. So John, I'm going to actually, before I come back to you, because I want to hit on refinances after I talk with Glenn and Eric, but what have you noticed in today's market when it comes to the 203K loans and, maybe people are doing the 20 to 25% down right now to buy a multifamily? Has business drastically increased during this time frame right now?
It's been the craziest couple months in history. It's been the busiest months I've ever seen. Houses are flying off the market. People are refinancing all over the place. Everything is moving slow, but I've never seen it. We can be working 7 days a week, 24 hours a day, and still not catch up. I've never seen anything like it. So any seller out there who wants to sell, now's the time to do it. Anyone that wants to refinance, now's the time to do it. You're going to miss the boat. Come the election time, we don't know what's going to happen with elections. Last year, the rates immediately the next day shot up. But they're saying rates are going to stay down for quite some time now.
Right.
But I wouldn't miss the boat. Do it now while you can.
Such a good point. All right, John, I'm going to come back to you soon for talk a little bit more about the refinances. Okay. Guys, if you guys got any value from John, let me know in the comment section. Let me know if that was a fun little section. Just give me the yes with capital Y, capital E, capital S, and make sure you guys hit the like and share button. All right. All right. Let's go to Glenn and Paul. So you guys are with private lending, right? Now, real quick, before we get into this, there's a lot of, hard money lenders out there. There's a lot of lenders that are out there right now. So can you guys kind of give me a little background on kind of, how peak private lending all came about? And in addition to that, like, let me know how are borrowers working with you in today's market?
I'll tell you how it came about. You can go into that.
Go ahead.
Well, first of all, I had gotten started in the lending, I said before, way back in the 1990s, and it was just really out of pure demand of investors out there that, for a few reasons, they couldn't qualify for any bank financing. They couldn't qualify for the hard money criterias. And what I mean by that is, hard money is a great vehicle. Okay, but you'd have to meet certain criteria, and the people that were out there were either beginners or they didn't have sufficient deposits to put down. Their credit was not up to par. Okay, now me as a lender, I would lend my private funds, my own personal funds at the time, based on the asset, based on the deal, based on the analysis. And since this is what I've done for so long, I'm really good at doing the analysis. So I know a good deal from, a deal that's not good. So I'm not really looking at that person's credit. Things happen in people's lives where, their credit gets a little messed up. It shouldn't stop them from entering into a profitable deal. So I have looked past that. I look past their reserves. I'm looking at how they're getting the projects done and if they need any assistance that we can give. That, as private lenders, as investors, we can do that. Hard money lenders, it's just not what they do. Okay, they have a lot of financial experience, and that's what they do. So that's like one of the differences just between the hard money and the private. Paul's going to delve into it a little bit more. But that's how I got started. So I was helping so many people with money, and quite honestly, I was making a very good return in a business. I was watching my money. I wasn't putting it in the stock market. I mean, we've all kind of done that where we had no control. I had control over the funds. I was able to get a very good interest rate, and I was able to protect the money. And this is, later we'll talk a little bit about how you'll get your own private lenders as well.
And I think too, we saw back then, we had a lot of wholesalers that were either wholesaling us deals, and then they were looking to take that next step. And that next step for them was to go to the hard money lender and borrow on their own. So we saw that trend of, hey, the people that were wholesaling to us because we were buying were now going and either, partnering with somebody and going 50-50 or trying to go to a hard money lender or a bank. So we did see that there was a little opportunity there to lend our capital to them. And a lot of those people were, like I said, wholesalers looking to take it to the next level. They're still borrowing us from today, and they were able to scale their business. I think that's how it kind of started. And then, in the last 6 years with the low interest rates and the hot market, a lot more money flooded into the space, which is a good thing, right? So we all have options now. But I think it goes back to, vetting the people that you're doing business with. And
and we would, again, we were lending our own capital, and that, like I said before, that could only go so far. And then we were having friends saying, hey, listen, can I come in on this or whatever? And, we said, sure, you can come on in. And one of the things I think maybe Eric will probably touch on a little bit too is when you talk about credit lines and things, I was doing that as well. Hey, we need another $500,000 or $1 million to put out. I would go and hit credit lines and get that money. And at that time, the rates, I think, were like 4%. And, we were putting it out at 11, 12, 13, 14, 15%. That's what it was 20 years ago.
Right. And being that we do most of our business in New Jersey, which is our backyard, we're able to be a little bit more flexibility on some of the terms with some of the borrowers, which, things like no credit, no experience, no appraisals. There are certain things that we could do just because we're controlling the money, we're controlling and comfortable with it.
And this is why so many times, Elijah knows, he's been to a lot of our meetings, and we had workshops and seminars. So I took that educational part and started educating the borrowers that were out there so they can go out and find better deals. How do you find the best deal? How do you analyze it correctly? You bring me a correctly analyzed deal. I'm not looking at your credit. We're not looking at your experience. We're not looking at your reserves. We're not looking at your deposits. So, but again, this is coming from lenders that were investors. Okay, banks not going to do it. Hard money lenders really just not their thing. Okay, yet they're very good to have in your tool belt as well. We work with a lot of them, the hard money lenders as well.
And even from a raising capital standpoint, it takes time, it takes effort, right? You got to build credibility. You got to sell somebody that you have a valuable deal. And for the couple of people I talk to, they like using us because they're leveraging their time. So they know the money's going to be here, right? They're taking advantage of our capital raising or our capital, and they're going out and saying, you know what, I'm really good at finding these deals. So I'm going to leverage my time because we're using a private lender. They may be paying a point or two more, right? Everybody wants that 7-8% money from an aunt.
Your uncle.
Right. Exactly.
Absolutely.
And we encourage that. You should.
I teach people how to do it, but you just can't do it overnight. You really need to set that up. When you're asking somebody for, $300,000, $400,000, $500,000, you need to lay that plan out for them. And I use these words. You got to make them warm and fuzzy. Okay. They're not just going to turn. They'll all say they want to do it until you say, okay, we're closing next Friday and need $275,000. You're going to, sometimes it's not so easy.
And I think
but if it's done correctly, you can develop your own.
Right. And we had an example, I think, of where, somebody had their brother that was setting aside money for them or whatever, but the guy didn't have a deal. And then 3 months later, it was like, well, no, his brother and his wife may be moving, and then now they're going to put an add level on the house, so they need that cash. And now all of a sudden, the guy was banking on the money from, the friend or the family member, and it was like, oh, wait, we don't have it. So I think, thinking about, you should always try to raise money and raise capital. I think that's
But you need to do it correctly, because relationships can be ruined. I mean, we all know this. If you borrowed $100 way back when, and your friend doesn't pay you back, it's like, hey, Bob, Larry, Joe, Alice, where's my $100? Try that with $200,000 and $300,000. So again, it just needs to be done proper, needs to be done correct, needs to be set up correct. But a lot of the investors that we see say, you know what, I don't even know if I want to go through that. I'll just get it from you.
Right.
Okay, so maybe they're not getting it at 6% that their uncle would have given it to them if they gave them all.
And that's the advantage of the hard money lenders, right? Their capital is unlimited. So they have, well, for the most part, as long as they're lending, it's unlimited. So you don't have to worry about it there. But you want to make sure your goals are aligned with those capital people and those hard money.
Do you want to tell them what the difference is real quick, but really what the difference is between hard money lenders and private money lenders? Okay, like the hard money lenders where they get, they get their funds from the it's institutional money, which is fine. Okay, that's why they have certain criteria. Private lenders, if it's your private lender, you have less strict criteria on that. And they're usually using their funds, just like when I started, it was just my personal money, okay? Or now some of the private lenders may even put a group of guys or gals together. It's okay, let's put $1 million in this pot, and we're gonna lend it out, and we're gonna get a better return than we're getting in our bank right now, which is, I don't even know what it is, it's so low.
Right. And I guess just to go back to your point, Elijah, I think people will use us too if they can't. And a lot of even hard money lenders, we have great relationships with even the local hard money lenders. If they can't get something done, they can lean on us and say, hey, give Peak a call and see if they could put it through. We do get a lot of those type of loans. And obviously the crisis management type situations where, maybe your project's half done, you're falling behind on payments.
We get a lot of those.
We get a lot of those.
Yep.
And that goes back to making sure your goals are aligned with your lender. It's very hard, right, to finish a project when you have a list pendants against you, they're foreclosing against you, there's a lot of pressure. And we've seen it a little bit like in the last year where we've been able to come in and help the borrower out of a sticky situation.
Way back for 20, it hasn't happened a lot, but you know what? It's a business and it does happen.
Right.
Okay, they're from the experience to the newbies. This is a business like anything else. You're going to hit bumps in the road. Unexpected things are going to come up. Unfortunately, on this business, if you're dealing with a house, it could be a $10,000 or $20,000 bump that comes up that the investor just doesn't have. So what happens now? They go into default. We don't want anybody going to default. We'll come in, we'll step in, we'll bring our guys in and finish the project for you. And I've done this a handful of times where they actually, instead of losing the house, going into foreclosure, they ended up walking out with their $25,000, $30,000 profit.
And to piggyback off that, that's where Eric may come in too, because if they maybe had a backup plan for, I'm not talking about a crazy amount of money, but if they had an extra $15,000 or something, right, where, we had a crazy scenario where, the only way the guy could finish the project was by not making a monthly payment to the hard money lender. And he had to make a decision, right? And obviously we spoke to him after the fact, but after that third or fourth missed payment, he was slapped with a list pendants. And now the sweat really started coming down. Where I think back to that, and like if he had and the guy had good credit, Eric probably could have done something for him. You never know. That's why I think we stress upon having those relationships to kind of fall back on. I think it's important.
Yeah, I think that the real experienced hardcore investor that's done 50 projects, not 3, 50 projects, can go to anyone and say, okay, John, here's what I want. This is the rate I want. This is what I want to pay, and this is how I want to do it.
Right.
Because he's going to get it done. He or she is not going to fall into default. Yep. But the one that maybe has 2 or 3 or 4 or 5 is really not a lot, okay, in this business. And things will come up where they could fall behind. So again, that's just kind of where we kind of step in. That's just our niche. That's what we've done. It's riskier, but that's what we've done.
So I love that. You guys hit on an amazing point, which is the qualification of a lender. And when you can find a lender who, give me a second here. When you can find a lender who has their own source of capital, you can now talk about terms. Now, not as a newbie. I don't mean as a newbie, okay? Because as a newbie, you really need to learn to listen. And so, Paul and Glenn, let's say I'm brand new, okay? What do I need to look like? Who do I need to be in order to qualify for a loan from you guys? And if you guys want to run through like a hypothetical example, that would be great for anyone who's listening.
Yeah, I mean, you could be brand new with a lot of money, right? So somebody would say, okay, because you're brand new and have no experience, you got to put down 30% or 40%, and they could get you like that. Some may flat out not even lend to you. The next piece of the puzzle is the rehab risk. Can you manage a rehab? Are you doing a $25,000 rehab, or are you doing a $125,000 rehab? Like I said, I think our locality and our investor background, I think we kind of can mitigate some of the issues that we see with scope of works, and we can, analyze the deal for the newbie. But really, when you're a new investor and you haven't managed a rehab, when you think about it from a risk standpoint, it's risky, and it might take a little bit more of hand-holding from somebody, whether it's, somebody who's been in the business for, 10 years, 15 years.
Especially with their estimates, everybody's always primed to say, okay, let's get, you get a price for somebody to put your roof on your house. You want to get it lower, right? We want to get our floors done. We want to get it lower. We look at their estimate and say, you know what? I don't think you have enough here. You're putting $60,000. I can tell by the pictures, right? We look at the pictures and go, this is going to be every bit of 90 to 100. Okay, so just because that person has some money and is going to put it down, we're not always just going to say you can get the loan. We're going to tell you, you're not going to make any money here. Okay, well, I'll put more money down, but you're not going to make any money.
Right, and if we could guide them, I think, like you said, if you were coming to us as a newbie, and we could kind of mitigate that risk of them failing, whether it's what they're purchasing it for, or the thing that we battle with every day is the after repair value.
The key in the business.
And we've disagreed on after repair values with people, and I could hear the people in our mind. Well, I'm going to make it the best, and there are people from New York coming over, and it's going up 20% every 3 months, and they may be right, and they may totally kill it and whatnot. But like I said, more often than not, we're playing the percentages.
And we tell them, you know what, we have money to lend. We want to lend the money. It's not like your uncle that says he wants to, but maybe doesn't really have it. We got to put money out on the street. That's how we make money. So, but we also want the investor to make money.
And I think, like I said, because we're local and we're checking on these properties, we have people watching the properties. So if you are new, we like to think that we're going to be able to step in and mitigate something and stop disaster before it happens. But everybody's new and everybody, it's their first time, right?
Yep.
My first time in 2001, everybody has the first time. And I think that's something we kind of prided ourselves on when I just remember a lot of these wholesalers, and even today, when they take that next step to doing their project, we kind of feel like we have a part in it, to getting them over the hump. Even if it's, if we think a price is too high or too low, I think that's something that we've done over the years, and we've gotten people kind of off the ground, and then they could say, hey, we've done 1 or 2 or 3 projects, whether it's a joint venture or
which we do too. We do a lot of, we do joint ventures. If somebody just doesn't have the experience, they got a great deal, they'll ask for help. We'll do a JV at really favorable terms to them. Okay. And just real quickly on partnerships and JV, they need to be structured properly. I've seen so many partnerships. They all look, great and rosy and cheery, and I could just see what's going to happen down the line. And unfortunately, a lot of them fall apart. It's because they're not set up correctly. And even on our workshops, I teach my fast track students how to set them up correctly so you don't fall into that. We don't want to ruin relationships, especially if it's friends or family.
Right, and I kind of joke around and say we're kind of like a soft partner. So we may not go 50-50 with you, but if we're going to put out our capital at a certain rate, we get a lot of people that come from the 50-50 world, and they say, well, if I can put down a down payment and get hard money or private money, it's almost like having a soft partner. It's kind of the way I look at it.
Yeah, no, that's such a good point, and I think that's definitely one of the things that make you guys different than like almost every lender that's out there right now is your guys' analyzation process, kind of your willingness to hop on the phone and talk about the real facts. because so many of us, we want to put emotion into what we're doing. Oh, we can do this and that. Oh, I heard this and that. My realtor said this and that. The contractor. It's like, no, 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 no. We got two guys right here that know the facts. They know the risk. Okay. They're willing to put their money on the line. So we got to learn to listen and just take the advice.
And I think that too, Elijah, to piggyback on you, and I'm sure John and Eric could agree, just make sure you're comparing apples with apples, whether it's an estimate, whether it's mortgage rates, whether it's, whatever you're getting out there, because there's a lot of noise, right? There's a lot of noise that gets filled. And I think, especially when it comes to creative financing, whatever, you just need to make sure you're comparing apples with apples. And I think it would be unfair to Eric or John if, John was telling you the flat out truth coming at you straight, and you're making a decision based on a totally different set of, guidelines or circumstances. So I think comparing apples with apples is important in this business.
Yeah, that's such a good point. So we heard from John, and John was saying that, sometimes his renovation loans for us as an investor, there's a single family we wanted to fix up and flip. It might take 45 to 60 days to turn around, which, in this business, that is a lot of time. It can be done, but it is a lot of time. So for you guys, what is the rough turnaround time, from the time that we meet you to, making sure all the numbers are good, to turning an application to getting a loan? What's that process normally like, and what's the time frame for that?
Paul always says this, and it's never the money. Okay, again, we are private lenders. It's our in-house fund, so the money's there. We don't need to take your application and send it somewhere for them to approve it or disapprove it. So if you give us the documentation, which is basically your inspection, your title work, tank sweep, your scope of work and estimate, so we can see, okay, you put down 90, it's about $90,000. We can close, I want to say the next day. It all depends on title. Okay, right. So again, we look at it, we go, this person's got a great deal. They got the inspections done, they got this done, here's their estimate, here's their scope of work, here's the pictures, I see what's going on, I like it, you got title, we can close.
It's got to really pass the valuation point, right? Like when we see a deal and we just say we do a valuation and our valuation in-house is agreeable to yours and we don't need an appraisal, right? We're moving forward. We try to get to the property in the next day or two, look at your scope of work. If they haven't even ordered title, saying I can close in 1 to 3 days is, to me, I don't know. It's like it doesn't mean anything to me.
And I hate to say this because, we've closed deals within days, okay? Right. Even having to run title. We don't like to do it, but some of our borrowers are just under the gun and we dropped what we were doing to get it done. Okay.
Now, and a lot of that goes with like hearing the rest of the story, right? COVID hit. And March 13th to March 31st was probably like the biggest nightmare for us because our phones were ringing off the hook.
Yeah, unbelievable.
Did we close a deal in 24 hours? Yes. But you know what? It was all teed up. Appraisal, everything was in line. 3-bedroom, 2-bath in Linden, New
That
Jersey.
time they had other lenders that weren't, because of what was going on, understandable.
Right.
They couldn't fund it. So now, but it was all ready to go. I would say not the hard money lenders' fault either, but
I would say 5 to 10 days is when you're going to fund one of these things. If you put something under contract and you're really good at getting us what we need, I want to be the last person to hold somebody up in closing. But if we have a value variance, that's going to hold things up, right? Glenn says it's worth 380, and I say it's worth 300. So we need help, right? We got to get an appraiser. We got to get somebody else. And if that could adjust, maybe I missed something. Maybe the appraiser brings something out that we missed.
And I think I put a post out with this, don't be so anxious to close. Make sure yourself, make sure your estimate's correct. Make sure your scope of work is correct. Compare apples with apples. When someone says, well, your estimate is 80,000, I got somebody at 60. That's a big gap. Okay, 65 to 70, 75, fine. But no $25,000, $30,000 gaps.
Yeah.
Right?
Yeah, that's such a good point. So I have 2 more quick questions before we go on to Eric here. So when it comes to down payment, right? Because you guys will fund projects that need big rehabs, added levels, stuff that might need not a lot of rehab. And you guys are way more flexible in terms of the time frame. And as well as, if they're experienced, you're willing to talk about terms a little bit. So can you talk to me a little bit about kind of what down payment is like for you guys, and how are you seeing investors put together the down payment right now?
Okay, they'll put that together, the down payment. They'll either have the money and can show us, that we can fund it ourselves.
Yeah, but they're putting down basically it's about a 10% down payment
On the purchase.
on the purchase. Okay, then obviously 100% on the rehab cost. They can get that, which I think Eric's going to talk a little bit about. There are a lot of creative ways to get that down payment. Again, the big thing a year ago was the gap funding. That's good. Gap funding is good if it's done correctly. I've seen many gap funding people lose their money. Okay, so you just need to do it correctly.
And you got to remember, right? The gap funder, they may not know what an ARV is. They may not know what you're into it for. So you could put down $70,000 and get a loan, but is it dumb money? Is it going to take a lot to get that back? Whereas if the deal's analyzed correctly, it may fail our profitability analysis. We may say, listen, man, if everything goes right, you come in on budget and you sell this thing in 4 months because everybody says they're going to get out in 4 months. You're going to make $16,000 or $12,000. It's just not going to fly. And the room for error and the room for loss, and who takes the initial loss, right? The down payment. And
I think I know we were, or I was anyway, way back when they didn't even have the down payments. I would make their down payments for them. Why? Because they had a good deal. It was analyzed correctly. They have a really good deal. So why should that person or myself lose out on that deal? Right. I'll give you that down payment. I'll put it down. Personal money, put it down, get you in that deal. And that's where that real, true 100% comes in. Okay. Now, hard money lenders are never going to do that because it's really, for most of them, it's not their money. So they have to be careful. And it's just like a private lender. If you have your own private lender and they're putting up all the money for you, they need to be careful. Okay. But again, we know the deal. We know how to analyze it. I'm comfortable. I've done tons of no money down deals. Do I like it? Hey, listen, we always like to see somebody have some money in it. But again, to answer your question, I was one of the first ones way back in the early 2000s to do that. And it's paid off, and I developed a lot of really good business relationships out of that.
So we see them either putting their own cash down, getting a small group together and get it privately. And I think Eric's going to have a couple ways to get some other types of funding. So it's just like you're raising that piece of the loan.
Right. And so just to hit on that, right, for anyone who's listening and maybe you didn't understand the big picture of all that, like these guys are willing to lend, like as long as the deal fits their criteria, they're willing to lend the rehab amount and as well as 90% of the purchase price. So the purchase price is $200. You need $20,000 down. But what Paul and Glenn hit on that is absolute like gold mine is that you also have to factor in that you're going to have taxes and insurance that you have to pay for and your holding costs as well. So it's not only just the down payment money that you need, but there's also holding costs that you have to make sure that you're, bankable in order to cover, especially over the months that you're holding on to a property. Because 4 months rehab, I learned this the hard way, by the way, because I remember when I first got started, I was like, oh yeah, 4 months rehab, $50,000-$60,000. No problem, can be done. And sometimes those things do turn into 9 months, especially when COVID hit. I had a few deals turn into like 3-4 months additional because like we didn't know what was going on. We didn't know if we should sell, should keep, so it's really important to factor in like the additional expenses and making sure that you have the funds available for that. And, running a deal by Paul and Glenn, like that's exactly what I would do. If you had a deal, I'd call them up, run it by them, see what they can do for you. And they're going to literally walk you through it and be like, yo, this is where purchase price is. This is probably where it needs to be. This is what the rehab is. Like they'll have those phone conversations with you guys. So definitely a resource to add to your teams. I'm going to come back to you guys so we can all dive into rates here in a minute. Let me go up to Eric here for a few minutes. All right. Eric, how are you?
I'm doing good, man.
So we just heard from Paul and Glenn, and we got these guys here. They're willing to cover 90% of the purchase. And some investors that are out there, they may be wondering, well, how do I get to 10% down? Can you use credit? Can you not use credit? Let us know how investors are working with you right now in today's market.
Great, thank you. Paul and Glenn hit it on the head in terms of where we come into play. A lot of our investors are using us to leverage their personal credit to go get lines of credit, $50,000, $80,000, $100,000 in lines of credit that they're using for the down payment with a hard money lender. They might be using it with the Johns of the world in the normal residential markets. I will tell you, the biggest where we're the most different is we're unsecured. So it's not based on you having a property. We're not tying it to a piece of collateral or an asset. It is primarily based on the strength of that personal credit for you to go out there and get multiple lines of credit in place, depending on the age of your business, the strength of your credit, as well as your geographical location. That's the
What
sweet
exactly?
spot. And
What is
go ahead.
geographical
Look like
location
you were
have
about to
to
say
like
something.
do with it? Like why is that so important?
Got it. So I have clients in every state, right? Hawaii, California, Florida, New Jersey, PA, New York, North Jersey, South Jersey, maybe Central Jersey. We'll see if there is a central. And depending on where you are, because there's some national lenders that a bank can help almost all my clients across the country. Then there comes down to smaller banks that might be regional. Maybe they're in 11 states or 15 states. So they might not lend in Florida, but they'll lend to New York, New Jersey, PA clients. And then it even gets even smaller where it's local lenders where they might only lend in a 60-mile radius around Philadelphia, or so they may not work for North Jersey, but they'll work for my South Jersey clients. So that's what I mean by geographical location. Where is your business based out of? Where is your home base? Where do you live? Because there may not be a branch within that certain mile radius for you to go out there and get that line of credit through a lender that's more lenient than some of the the more rigid banks of the world.
Makes a lot of sense. And so, when it comes to like an investor and they want to get the unsecured line of credit from you, I just heard you say that we can get, capital up to $50,000 to $100,000, but it all depends on our personal credit. So when it comes to you analyzing our personal credit, what does it need to look like? Have you ever taken a client on that may have not had the credit score? And if so, what kind of plans did you guys put in place to get them, so their credit's good? This way you guys can finance them. Talk to me a little bit about that.
Look, a lot of investors that we work with come to us and they don't know that they could leverage personal credit to get business money. So they're tapping into personal credit. And I was just talking about it in a webinar a couple hours ago. They're on this roller coaster ride, right? Where they're tapping into their personal credit cards, high usage, they see the score drop and they go into the low 600s. If the project closes quick enough and they can get their cash back to pay it off quick enough, score goes back up because the ratio drops. But if it doesn't, if it doesn't close quick enough and now they get stuck in a jam where a 4-month project's now into the 9-month, now sometimes what will happen is those lenders may start to say their limits on their personal credit may start to be affected. So it could hurt their credit from that perspective. So what we do is, that's a big part of what we're doing is credit strategies. How can we help somebody who might be using 50, 60, 70% of their revolving credit and credit cards and show them creative ways. We just did it with a client. She was using about 68% of her credit. We were able to show her, she had a private lender for about 10 grand. So she borrowed from that private lender, and then we helped them get a personal installment loan because the husband had strong credit or strong enough credit to get a personal loan because he had W-2 income. So then we were able to shift the rest of her revolving debt, the rest of her credit card debt over to the new personal loan. Her score shot up. We just started funding for her 3 days ago. She's at $38,000 in funding. We started her Tuesday, so 2 days ago. But yeah, so there are strategies that we run into like that. I'm not going to say I'm able to solve them all, but if it's not derogatory or delinquency related, we can come up with some creative ways, even with inquiries. Like our world is very inquiry sensitive. John, he may be able to see somebody with 7, 8 inquiries. As long as they can sign off on what the inquiry was for, it's probably not going to kill the deal. Peak's not even looking at credit, it sounds like, so they don't even know what an inquiry is. And then there's our lenders. If you have 2 inquiries, you may start to get denied if that next lender is the 3rd inquiry. So we work with a third party who can help clean up inquiries within about 30 to 60 days, if needed. So it's all part of what we see on a regular basis with our clients, because the unsecured world it's a different animal than the collateralized world.
Yeah, no, Eric, I think that's a great point. And I will say that a lot of, especially at our events, a lot of new people that do come, maybe their credit scores aren't so good, talking any numbers below 650. What is kind of some of the advice, or like, how do you kind of put people on the right track to get their personal credit secured? Because like the information that you just shared is absolutely insane. If you guys just monitor your credit and manage your credit correctly, like there's someone who's willing to give you increments of 50 to 100,000 to 30,000, right? Of course it depends, but like as long as you're willing to manage your credit correctly, you have access to a lot of capital if you were to plug in with Eric. So Eric, when you are taking on clients that may not have great credit, what's kind of the first few things that you kind of start guiding them on?
I'm going to remind them that credit's a marathon. It's long term. It's not everyone wants to sprint and get as much access to capital as possible, but there are moves and maneuvers that we'll make with the client that will help long term, help them get more business access, help their credit profile look stronger to John 6 months from now, or a year from now, or 5 years from now. Because I mean, we're all entrepreneurs. I'm a real estate investor. With the real estate investor, your credit's the three most important numbers or digits for you. And I learned that in '08 when I started to understand credit. I had been investing for about 6 years and had no idea that I could leverage personal credit to go get business money. Well, within 90 days, me and my wife had a couple $100,000 in lines of credit under the business, and never showed up on personal credit. So as we're tapping into it to build a portfolio and do a couple fix and flips and a few wholesales in there, none of it was showing up on credit. So I would still be bankable. John talked about being bankable. I still was working with commercial lenders to refinance on the back end. I still could go out there. I was leveraging a lot under the business through the lines of credit. I was able to get 5-6 mortgages for my rental properties under residential mortgages because I was bankable. My credit stayed strong. I had a W-2 income as an engineer, and we both, and I had cash in the bank that the lender didn't know that I was leveraging through lines of credit, but there was cash there in my mid-20s, more than most mid-20s, most people in their mid-20s have. So it's a way to really help you separate that personal and business credit. So I guess when I talk to someone who has young credit, is think of it long term. Also know that like I talked to a 23-year-old yesterday, and good credit, but only 5 years of credit. You're not going to qualify for a lot of business money with only 5 years of credit. I like to see 7 to 10 plus years. So when I initially talked to him, I told him, I said, look, I could probably start to help you, but it'll be more just building that personal credit stronger so that 6, 12, 18 months from now, we can go back and start to get you more business. I said, if you have a credit partner or somebody, a parent, a spouse, somebody who has more robust, longer credit, you can use them. His dad was on the phone. We reviewed his dad's credit, 25 years of credit history, good revolving credit, 801 FICO score. So we're going to leverage his dad's credit to go help him get capital under an LLC, so that the son, I mean, the dad's helping out the son. He's got his own practice in whatever space, the professional space he's in, but he's helping his son by helping him get $60,000 to $90,000 in lines of credit, so that they can go leverage it. And he's using all the tools that we're talking about here. It's just another funding tool in our toolbox as an investor, whether you're using the mortgage, the hard money, private money, lines of credit, and the 0% credit cards are just another tool out there for you to go, build that empire that we all want to build as investors for long-term wealth.
Man, that is absolutely a beautiful perspective there. Listen, guys, if you guys have gotten any value so far, please make sure you hit the like and share button. We're getting ready to open up here in a second to everyone, just to kind of talk about rates. And last but not least, if you guys have any questions, put them in the comment section now, whether they're questions for John, Paul, or Eric, specific questions that you want answered, put them in the comment section now. We're getting ready to pin those up. So Eric, real quick, before I kind of open it up to all three of us to really just kind of dive into rates and how things are going right now in the market, I wanted to know, like, let's say I was someone, I had decent capital. Let's say I have a decent credit score, 720-ish, 740, 750-ish. what would kind of be a major benefit to, coming to someone like you and inquiring about your services and maybe, getting that process set up to where I can receive those unsecured lines of credit? Like, what do you see as the major benefit to working with someone like you, assuming that we had the requirements to have access to this credit?
I'm going to go a step further. I'm going to say you have an 800 FICO score and you think you walk on water, right?
Okay.
We run into them all the time. Look, they have good credit. They've done a nice job of building credit. Where we come into play is understanding the lenders. Not every bank that says they have a business product is a true business product. Capital One, has anyone ever heard of them? Everyone here has heard of Capital One. Probably everyone watching has heard of Capital One. If you apply for their business credit card and you're approved, it shows up on your personal credit. Mm-hmm. Also, when John pulls a credit report, he's pulling a tri-merge. Not many line of credit lenders pull all three bureaus to make a decision. They pull one, sometimes two. Capital One pulls all three. So if you don't know that and you put Capital One early in a plan when you're trying to get a couple different lines in place, because of that's three inquiries spread against each credit bureau, that could affect your success with the next lenders, because our lenders are really inquiry sensitive. So what we know is the lenders that are true lenders, the ones that will report the business when they call themselves a business lender, and then, once again, based on your geographical location, lenders will pull different credit bureaus across the country. The same lender that pulls Equifax, if you're in California, they may pull TransUnion 80% of the time in New Jersey. Right. So that's the type of data that we have, so that we can create a pretty robust plan where we're applying for 5 to 10 different lenders to help you get $50, $80, $100,000. Last week we had a client within 20 days, got him $160K between some 0% credit cards in conjunction with a $25,000 and a $50,000 checkbook line of credit. And he wouldn't have been able to do that on his own, not because he didn't have good credit. He had strong credit, but he just needed the strategy on, okay, which lender do we approach in which order to go out there and get the right access so you can go do more deals.
Man, I'm telling you guys, if you guys don't have Eric in your phone book, you guys definitely need to add him, okay? We're going to get everyone's contact information here in a second, but really understanding that credit portion of things can literally drastically improve your life, not just your business, your life. Because it's one thing to have to wait on an opportunity and not be ready for it. But when you can start reaching out to guys like Eric, Glenn, and Paul, and John now and getting set up with them now, this way when the opportunity comes up, you're ready to pull the trigger. Like, now's the time to do it. And I'm so excited to just learn with you guys. And Eric, we appreciate you for sharing that with us. So I'm going to kind of open up to everyone here with Glenn and Paul. A lot of people are wondering about rates right now. Rates are for some reason at an all-time low. So can you guys kind of talk to me about like some of the rates that you guys are seeing? How are these impacting our real estate markets? And by the way, guys, for our viewers, if you guys have questions, put them in the comment section now. Okay, we're going to start pinning them up here in a brief second. So let's start with John. John, we did have a few questions about refinances. So can you kind of talk to us a little bit about the refinance game as well as some of the rates that are being offered at the moment?
Yeah, so as I mentioned before, it's probably the best time in history. Rates right now, you're seeing rates as low as in the low twos. The lower the term, 15-year, 10-year rates are in the low twos, 2.25, 2.5. As you're going to the 20, 25, 30-year terms, you're looking at upper two rates, maybe even the mid twos, depending on how strong of a profile. Qualification-wise, we're getting, they mentioned about appraisal waivers. We're getting a lot of those. So a lot of people that may think they don't have equity in their homes, we're getting a ton of appraisal waivers, not even going to the houses. With COVID, it's actually been mostly drive-bys anyway. People don't want anyone in their homes. So there's rules and regulations now that we do keep people safe, and we've been doing a lot of drive-bys. But the process has been it's a pretty easy process. If you're a wage earner, W-2, one pay stub, we probably don't even need any assets to show. Process takes about 30 days to do from beginning to end. And, it's really the best time to do it. Thank you, Fausto. It's really the best time to do it because the rates are they're fantastic. I mean, I refinanced all my properties, all my friends, my family, everyone I know. I'm telling them, please refi.
And let me ask you,
time
John, like, how do you think that's
Absolutely.
impacting our markets right now, in the investing as well as in the homeowner space?
Well, a lot of people are pulling money out of their properties, which, because it's the time, they have the opportunity to do so. Not only are the rates so low, but the values have come up, right? So being that there's value now, they're pulling money out and they're using that money to buy other properties. Now it's a big seller market right now. There's not a whole lot of inventory in some areas, so you're getting some 20, 30 offers on a single house in a day. I mean, sometimes in my office, I literally have multiple clients getting pre-approved to bid on the same house. So it's not crazy right now. But the rates being so low has really, really gotten the market going. I mean, people that didn't qualify, maybe we're just at a $300,000 house, now can qualify for 350, 370, just by that tick down in the rates. So I'm calling people saying, hey, now's the time to do it. They're anxious, they're moving. The market's really, really strong right now. So it's definitely a good time, and rates have been really helping.
That's awesome, man. We appreciate that, John. All right, let's go to Eric. So are all the credit, unsecured lines of credit, are they always 0%? Because I heard you say 0% earlier. Or what are some of the rates that you guys? What are some of the rates that you're coming across right now?
Got it. Yeah, no, some of the options are 0% for a period of 6 to 18 months, and then other lenders base their interest rate off prime. So it could be prime plus 0 to prime plus 5 on the high end. Prime right now is 3.25. Post COVID, it dropped 2.
Yeah.
Once again, like it just became cheaper money even in our space. So most of our clients end up prime plus 2 to 3, which is 5 to 6.25 right now, which
That's
is
great.
competitive.
Yeah, that's really competitive.
And the other thing I didn't mention is it's credit based, not necessarily financial based. Most of our lenders don't require financials. So even if you have that business over 2 years, we're working with some lenders that don't need tax returns.
That's even more crazy. That's awesome.
Yeah.
All right, Glenn and Paul, you guys are literally dominating the private money space right now. So can you guys kind of talk to me about some of the rates that you're offering some of your experienced investors, as well as rates that you're offering some of brand new investors who are kind of just getting started?
Sure. Obviously, with the lower interest rate market and the hot real estate market, just from a hard money and fix and flip perspective, money got flooded into the space, right? Which compressed the hard money lender rates, which is a good thing, right? Everybody's got different options. The rates lower. From a standpoint of the real estate market now, post-COVID, and I think we underestimated the demand a little bit, but the supply is low, coupled by these lower rates, and John spoke about affordability and things like that. No foreclosures, no evictions. So we're seeing, same thing like you said, John. It's crazy the amount of loan payoffs we're getting. We're definitely getting paid off more than we're originating, and which is a good thing. Our own personal portfolio, I think we only have 2 houses. We usually do about 8 to 10 houses a year. We only have 2 left in our portfolio, and we're kind of just hovering, looking for good opportunities. But from
the old one at asking and above.
Right, asking and above.
Like John said, asking and above.
It's been crazy. I think the hard money space now, you're probably going to see rates between 9 and 12%. And remember that the rate's going to fluctuate depending on multiple factors: how much leverage you're taking, what your experience is now, because post-COVID, the hard money space, they've adjusted their guidelines a little bit. But if you come with a 65% LTV deal, and you're going to be looking at somewhere between 10 and 2, 10%, 11%. Now remember, right? We got to compare apples with apples. If John says, but Paul, can you advance me the draws, and maybe can you defer me some payments? Now we're playing with some of the guidelines and the risk things that may bump your rate up a point or two. I've always been focused on the terms. A point here or there. I know it's money, and I would never downplay it. But over your 6 to 8 month renovation, and forget about if you're telling me you're going to get out in 4 months. There's certain things that may benefit you, by using a company like us. Eric said it before. We don't need to pull credit, so we're not. I don't even know what an inquiry is. We sub out the credit with an intro call or a sit down in the office and give you a couple minutes to sell us why your deal is a deal, and sometimes that could be just as good as the credit. But I'm probably not the best person because I think I'm cynical at best and paranoid at worst.
But a lot of people too, even like beginners, they would come to us and say, "Listen, I have this rate. Can you match that?" Absolutely. Okay, but then we have people that come in and we may give the rate, whether it's 10%, 11%, or whatever, and then they say, "Well, I heard someone is getting a 10. Well, you're so high at 11 or whatever." And I'll say, "Okay, let's see. You don't have enough down payment. You have no money for the draws. I need to advance you that. So I got to give you 10, 15, 20,000 as soon as you start. Right. And you really can't make all the payments. You don't have the reserves. So I'm going to help you with that. You're not going to pay that. And you're paying 1% more or 2. But I'll do the other way." Then they go, "Oh, no, well, I don't want to do all that." I said, "Okay, well, that's why it's 1% or 2 higher. But certainly can do the low ones. It's a better loan for us as well."
Yeah. And I think, that March, April time frame was a little bit scary. There was a major liquidity issue, and that's why I think the borrowers that work with us, they really, I think, saw the value in our relationship, because they did have an outlet to maybe close one of those deals that they needed to close, or and like I said, it's just having another tool in your tool belt to use. But they're coming back. The buy and hold loans, the alternative lending loans that we don't do and hold, in our own portfolio. I mean, there's some great programs where maybe they don't qualify for John's 3% rate, but they could get something in the 5s or 6s or whatever they sell at. We've had a lot of our borrowers that went into those type of loans, and there's a lot of good local lenders that could take care of you. That John, I think, has taken a handful of our borrowers out into the a couple of these multifamily buy and holds. But I guess to answer your question, Elijah, I would say 9 to 12%. Going in with an open mind, and like I said, vet that capital partner, man. See what they're giving you. See what you're getting. Because things like no draw fees or no exit fees or no prepayment penalties, that's all stuff that's going to happen after you sign the 40 pages of the note and mortgage. So you just got to be a little bit educated, and like I said, we'd be happy to talk to you about it, and I'm sure John and Eric, kind of know what to look for as well. But it goes back to, again, man, have multiple relationships with people in the business. That's why we're all here. And that's the beauty of these network meetings, because it doesn't have to be me. It could be Elijah, it could be whoever. And,
By the way, if you guys come to me about financing, I'm going to send you to one of these three. I'm going to send you to one of these three. So, no, but yeah, that's definitely a good point, man. I appreciate you for sharing that. And, rate is one thing. So don't get caught up in that. Just realize, like, these people are willing to give you the money that you need to get this done. And, if you can get one deal done with them and then do another and then do another, like, of course, you can have those conversations like, oh, well, how can we be a little bit more flexible in the rate? So don't always get caught up in that. Definitely some good points there.
Especially if people do multiple deals, they may do, Eric may help them to get into a deal with John, but then maybe John can't do another deal for them because they're not bankable or whatever. So they got to use a couple different sources.
Such a good point. All right, guys, so I've had you on here for an hour and 17. So I want to make sure we wrap this up here shortly so I can value your guys' time. I want to open up to questions. We do have a few questions here. And then when we finish off, if you guys could share your information with us, I'll ask for that. So you guys will be getting their information. Please give them a call and just introduce yourselves, All right, so let's get this started. So Seth asks, can you refinance to a long-term rental loan in an LLC without giving a personal guarantee?
Yeah, so I'll answer that. So right now, whenever we're doing refinances, we do have a lot of bars that do want to do financing in LLCs. Financing in the LLCs does eliminate a lot of your traditional lending. However, Fannie Mae does allow you to refinance a property into your name and then deed it to an LLC right after you close. And a lot of people don't know that. So I deal with a lot of investors because there used to be a due on sale clause that they could trigger if you are, trying to transfer the deed of ownership. It doesn't really happen often. However, it can happen. Not anymore. If it's an investment, you can transfer it to an LLC. It is going to show up in your personal name on your personal credit, but the protection is there at least. So that has changed over the years, which is now better than it used to be. All right. So, but you're still signing for it personally. It is still appearing on your personal credit.
Thank you, John. All right. Our next question here. All right. Our next question says, if we're new from Ashley, if we're new and we have a deal, can we call you guys and run it by you? You guys want to answer that?
Absolutely, right. Remember,
We do.
right. I mean, the quickest way on our website, you can get like a pre-qualification. And remember, to get pre-qualified very generally, like I'm buying it for 100, I'm putting in 50, and it's going to be worth 400. We're going to tell you, hey, man, those numbers look good. If we could verify the after repair value in your scope of work, those are really the only things we need. And then obviously, if you could get past that point, obviously we got to verify everything. But sure, that's not a problem.
John, if they had a deal, maybe it was good for a conventional loan or a 2FK, or maybe even a refinance, and they wanted to know about it.
The majority of the people that I've probably done business with are first timers. We don't look at experience at all. We look at numbers. We look at debt to income ratio, their debt versus their income. We look at their credit scores. We look at their down payment. Strictly off that. We don't care if they're first timers or if they have done 100 deals. So it really doesn't matter to us. I'm happy to work with anyone that's brand new and guide them. And if they're not ready now, we'll get them there. That's mostly what I do.
Yeah, that's a very important point, because even if you're not ready now, like, still do it. Still make the phone call.
Get yourself ready, prepare yourself, because everyone, if you just follow the right steps, you'll get where you need to get.
And Eric, you'll hop on a call with someone, right?
Oh, absolutely. Yeah, I agree. Have the conversation, see what we do, and we'll give you some strategies to get you in a good position for some access.
All right, perfect. Let's get to our next question here. Guys, we got time for like 1-2 more questions, all right? Richard asked, Eric, is placing business loans, how about a sole proprietor, no corporation involved, rate was 700 score?
Nice.
So if they have a 700 score, I'm a little confused by the question. If they have
I know he's asking from a business perspective, can you help someone who doesn't have maybe an LLC or a corporation set up? It's just set up as a sole proprietor. Yes, we can. There's not as many options. You lose a few options with the sole proprietorship, but we'll use that sole proprietor EIN to help you get capital under the business the same way that we can, the person who has an LLC. So similar interest rates. It's going to be, some 0% money, and then some money based on prime +1, prime +5, somewhere in that range.
Perfect. Thank you, Eric. All right, guys, it's an hour and 22 minutes, so I have to respect everyone's time. So listen, we covered a lot of really valuable stuff here today. When it comes to using other people's money, I think it's so important to understand a little bit about yourself, and kind of with what Eric said earlier, it's like, work on your credit, work on managing your money, right? Don't just go out hopping around, jumping into deals and stuff. Like these 3 guys here, well, there's 4 guys, but these 3 gentlemen here with the organizations, like, you got to look at them like as like teammates, as part of your mentorship. And they're willing to hop on a phone call with you and go through a deal. Not very many people in the industry are willing to do that without wanting something from you. These guys are willing to offer their time, hop on the deal with you, review the scenario, and talk about strategic ways to structure it so you can get it done. So make sure you guys take advantage of this. These guys are volunteering their time. We're super grateful for it. I've learned a lot today, just knowing what's kind of going on in the markets today. So let's finish off with this final question, and then we're going to give out your guys' information here. John, by the way, send me your info in the private chat. But let's finish off with this final question. So what would you guys kind of say or advise to people right now with kind of where we're at in the economy? Because there's a lot of people that are saying, oh, after the election, who knows what could happen. So what are some of the things that you guys should say we should do when it comes to putting our finances together to make sure we're ready for opportunities as they come up? We'll start off with Eric.
Get ready now, because when the opportunities come, a line of credit doesn't come into play overnight. So I always say give yourself a good 30 to 45 days to get the lines of credit in place, even though the lenders could respond back in 7 to 21 days. With the opportunities that are going to come and always be there, you want to be ready. I'd rather you be 3 months or 6 months early and prepared versus 1 day late and miss out on a good deal because of lack of access.
Very true. John, you want to add to that?
Yes, I mean, I agree 100% with Eric. Get yourself ready now. With the election around the corner, there's a lot of, indefinite of what's going to happen, right? So I mentioned last year, you saw rates shoot up the next day. We don't know where to be, but the smart thing to do is educate yourselves as much as possible. Learn from guys like guys from Peak and Eric. I mean, these guys are in the business a really long time. We've closed thousands, not hundreds, thousands of deals in our careers. There's not a scenario I haven't seen. So just educate yourselves, and that's the best thing you can do. And get yourself ready. Take the right steps to get yourself where you need to be as soon as possible. There's a lot of great opportunity out there, so I'll leave you with that.
Appreciate that, John. Paul, Glenn, what do you guys got?
30 seconds? You could do 30 seconds? Okay. I agree with everyone there. This is a great time. And, the rates have never been this low. The supply is not great out there. The demand is great. I mean, if anyone's going to buy a house, now's the time at 2.5% or 2.75%. Okay. And if you are getting into this business, I'm a big proponent of get the education, speak to the experts that are on this call as well, and do your homework, and don't be afraid to go out there and make offers on properties. You have a support team. You can start with us as well. And like I said, the demand is there. It's a great market right now. Now's the time to get in it.
And while you're making the hay while the sun is shining, just make sure that you keep your emotions in check. You block out the noise, and you gotta remember, right? Things up 10 and 20%, it could get a little bit dangerous and a little bit speculative. So we're seeing it here a little bit. People willing to take that little bit extra risk, and while it can be very profitable, know your market, stay in your area. And like I said, it's a great time, but in the same sense, in the back of your mind, just make sure that you're protecting yourself and staying safe. And that's, we've seen times like this when, he's getting his tooth filled and his dentist is talking about a condo conversion that he's doing. And, I get visions of 2003, not that it's going to happen. But remember, right, we're making higher sales since, June. So just make sure to keep an eye on those rates, keep an eye on the supply. And like I said, coming to these things and listening to the people that Nick and Elijah have on, whether it's us or whoever they have on their panel, I think is a plus. And like I said, if you ever have, any questions, call Glenn on his personal cell phone. And
I'll be in Florida soon as we can start flying again. Like keeping Elijah to making me work here. Yeah. It's starting to get cold, you know what I mean?
But thanks for having us on.
Thank
Elijah.
you, Nick, and thank you, Elijah, for all your members out there. They do tremendous work. It's a lot of work that they do in the 3 states. We have our meetup. Elijah and Nick have 3 states worth of meetups. So, we all appreciate their efforts, and I think you all should too. Great group. Thank you so much.
Well, the feeling's definitely mutual. And gentlemen, we thank you guys so much. As an organization, we're so grateful for your guys' time. But we have to know, we want to call you guys. We want to get pre-approved. We want to run some deals by you. We want to let you know what's going on in our lives. What's the best way to get in touch with you guys? Let's start off with the one, the only, Mr. John Palumbo from Freedom Mortgage.
Just call me on the cell. I'm old school. I like to talk. I like to get on the phone. I like to explain things. Call me on the cell. Shoot me an email. It's right there it's right there posted. I'll be happy to help you guys out.
By the way, for anyone who's watching the review, maybe they're not paying attention to their phone, they're driving. John's number is 973-699-3797. And that is his cell phone, so he don't want no late night text messages, all right? 973-699-3797. John, we appreciate you, man. Thank you so much.
Hey, my pleasure. Thank
all
you.
right, let's go to Glenn and Paul. How can people get in touch with you guys?
Call him.
I always try to stress, even if you have a deal or whatnot, if you could come up with the basic bones of it, it always helps. We get a lot of inquiries every day. But like I said, I would say the best is probably to email, follow up with a call. And like I said, if you have a specific deal or you have something under contract, that's something that we need to speak about immediately. But like I said, just call and set up an appointment. But the more information you can give us at the beginning, the better and the quicker and more efficient, response I can give to you. I think that's the best advice.
That's definitely a good point. All right. And last but not least, the credit king, baby, from MB Capital Solutions, Mr. Eric Mize. How can we get in touch with you, brother?
Look, man, the best way, direct cell or text, 856-556-0830. I like scheduling a 15, 20-minute intro call. So my Calendly link is on there as well. You can schedule with myself, my partner Nick, or one of our lead strategists, Chris, and we can get to know you and see how we can help.
I love it, guys. So I'm putting their contact info in the private chat. So if you guys are watching the replay, just know that it is posted down there. On this call today, we literally dove into the topic of OPM and really understanding, the different criteria, whether you're getting a conventional loan, 203K loan, maybe you already have a property and you're wanting to lock in those low rates right now. John's definitely got to talk with, or maybe, we dove in with private lending and what the difference is between hard and private. And then, how Paul and Glenn, they literally have control of their own funds. So they're much more flexible, definitely a great group to work with. And last but not least, how you can get anywhere from 30, 50 up to 100 to even more of unsecured lines of credit with Eric. So these guys are definitely good guys to touch with. Their numbers are posted in the comment section. So give them a call, let them know how grateful you were for, their time tonight. And once again, this is another event brought to you by NJ, NY, or PA Real Estate Investors Association. We're super excited to be here, and we will be back soon, but I do want to let you guys know in the future, the majority of our events are going to be for our Prime members only. So make sure you guys are staying in tune. And for our members, we're going to keep things rolling. So thank you guys, and I hope you guys all have a great night.
Good night, you.
Thanks a lot, guys.
Good night, Eric. Good night, John. Good night, Eric. Good night, John.
See you, John. Good seeing you guys.
Good seeing you guys. Always a pleasure.
All right. All right, Eric's posted. So we got Eric, John, and Glenn all in the private chat. All right, guys, have a great night. Bye.